Now we're going to be talking about your money. And does owning bonds make sense these days? Woodard Peay is with the Welch Group. He joins us now with the answer, hopefully. Good to see you this morning.
Good morning. How are you, Mike?
Pretty good. Filling in for Stewart Welch today. And, you know, back in the days, I know my parents, that was a time you really want to invest in U.S. savings bonds because back in those days it was a good investment. That has changed now, right?
Absolutely. We are dealing with some of the lowest prevailing interest rates in 50 years. So it's a little bit of a difficult case to make to buy bonds from an absolute return perspective. However, they still serve a purpose in your portfolio. And
let's talk about that because, you know, if we're talking about some volatility, and I know that is expected. You talk to your analysts on Wall Street, they're saying we could see a lot of volatility, but that is a way to protect your portfolio, right?
Absolutely. That would be the number one reason for owning bonds in a portfolio that was otherwise dedicated to 100% stocks. If you think back even a couple of months ago when the United Kingdom voted to exit the European Union, there was some severe selling of stocks for a couple of days. If you were an investor who had 100% stocks at that time, got caught up in that panic of selling and went to cash and are still in cash today, you've missed out on a lot of opportunity.
So people I know investing in their 401ks, maybe you don't check it every day, but if you do, what type of balance, what should the balancing be, bonds as opposed to stocks?
Well, that is a spot-on question because that discussion, the asset allocation, while rather boring, drives a large percentage of what your actual results are. So with our clients, we always start out with a 60% allocation to stocks, 40% to bonds. And the reason we do that, if you look at recent market history, that has captured about 80% of the stock market's return with about half of the risk. So that's the holy grail of investing, right. Higher returns, lower risk. There's other factors that might drive us one way or the other with a given client and their particular case facts, if they're near retirement, if they want cash flow, if they're risk averse, et cetera.
Now I've heard speculation now for about 4 years that the Fed's going to raise interest rates. It still hasn't happened, but that speculation has intensified here lately. Now obviously if you're borrowing money, it's not good, but what about if for bonds and also CDs and other types of those types of investments?
Well, the risk you run with owning bonds is if interest rates in fact go up. So what we're doing is owning decidedly shorter term bonds that would have inherently less interest rate risk because as rates go up, bond values drop. So we have shorter term bonds guarding against that risk.
Okay, some interesting stuff right there, and we appreciate your time as well. Coming out of the bullpen, filling in for Stewart. Thank you.
Thank you.